Welcome back to the ProTicker Podcast, your Tuesday morning edition, covering major financial magazine headlines, everyone. Today, we're diving into a stack of your sources. We've got recent reports here from CNBC, Bloomberg, MarketWatch, and Yahoo Finance. We're going to unpack some of the key market and economic headlines from this Tuesday, May 27th, 2025.
That's right. And our mission, as always, is to try and cut through the noise a bit, pull out the key insights, and help you get informed fast.
Yeah, it looks like a really complex picture today. Lots of different signals coming from, policy shifts, bond markets, and then specific sectors like tech, auto, even luxury goods.
Definitely. The sources you sent over show markets reacting to this, fascinating mix of top-down policy stuff and then bottom-up corporate news. It's pretty dynamic. Understanding the connections is key.
Okay, so let's start with what really felt like the big headline driving the market open today. Straight out of the trade policy world, we saw news that President Trump decided to delay those planned 50% tariffs on EU imports.
Yes, that was the major news breaking over the holiday weekend. Reports across, basically all the sources, CNBC, MarketWatch, Reuters, Yahoo Finance, they all confirmed the deadline's pushed from June 1st now to July 9th.
Okay, July 9th.
And this apparently came after a request from European Commission President Ursula von der Leyen. She indicated the EU is, quote, ready for swift negotiations.
And the market reaction, at least initially here in the U.S. coming back from Memorial Day, was pretty clearly positive, right? Futures jumped.
Oh, absolutely. The sources point to a noticeable relief rally. You saw Dow futures up about 1.0%. S&P 500 futures climbed 1.1%. NASDAQ 100 futures popped 1.3%. Big moves.
Wow.
And European markets followed suit. The Stoxx 600 added nearly 1%. And interestingly, European auto stocks, which have been really under pressure, they rebounded over 1.7%.
Okay, but that relief wasn't universal. Looking over at Asia Pacific, the picture was a bit more muddled, wasn't it? According to CNBC and Yahoo Finance.
That's a really important point. Yeah, mixed trading over there. We saw gains in Japan, Nikkei and Topix both up over 0.5%. But South Korea's Kospi actually dipped slightly, kind of reversing its recent highs. Mainland China's CSI 300 also retreated. Though Hong Kong's Hang Seng did manage a gain, India was down, but Australia's ASX 200 continued its climb. So, yeah, definitely not a uniform reaction globally.
Right. Now, despite that initial pop in the U.S. and Europe, the analysts quoted in these same reports, they're really urging caution, aren't they?
Very much so. The consensus from the Market Watchers cited in CNBC and MarketWatch is that, look, the threat of escalation hasn't gone away. They're using words like massive uncertainty.
Massive.
And the key thing is, if there's no deal by that new July 9th deadline, the thinking is the EU will feel it has, quote, no choice but to hit back with major countermeasures.
So just kicking the can down the road, potentially.
Well, there's definite skepticism about whether 6 weeks is really enough time to iron out all the details. Maybe enough for a framework, perhaps, but the risk is still there.
I saw one analyst in, I think it was a CNBC piece, described President Trump's move as sort of shock tactics to gain leverage in the talks.
Yeah, that perspective was mentioned, the idea of using these big threats to force concessions. But the sources also suggest the view from the EU side is quite different. They see it as negotiations among equals, and they're not expected to just, fold.
Right. And what's interesting is that the threat itself was already having real impacts before this delay, wasn't it? The sources mentioned some examples.
Exactly. Tangible effects. There were reports about French President Macron sealing a deal with Vietnam for Airbus jets, maybe diversifying supply chains there. And Volvo Cars, which remember is owned by China's Geely, they announced job cuts, pulled a specific China-made car from the U.S. market, and even withdrew their financial guidance, citing the tariff pressure directly.
Wow. So it's not just market jitters. It's hitting real corporate decisions, global trade flows right now. And for you listening, this lingering uncertainty, it hits investor confidence, it impacts supply chains you might depend on, and it has the potential to affect prices.
Although it's worth noting, one analysis from Goldman Sachs mentioned in the sources suggested that while tariffs could lift inflation, it might not be a sustained surge if the economy slows down later this year anyway. So it adds another layer of complexity.
Always more layers.
Okay.
Let's shift gears now from trade tensions to bond markets. There was a global rally today, and it seems like the catalyst was really news out of Japan, based on the Bloomberg and Yahoo Finance reports.
Yeah, this is a fascinating example of global linkage. What happened was yields on those super long Japanese government bonds, the JGBs, think 30-year, 20-year, they slid quite notably today.
Okay. Why?
Well, it followed reports from Reuters suggesting Japan's finance ministry might be looking to reduce how many of those super long bonds they issue going forward.
Reduce supply.
Exactly, and traders took that as a sign that authorities are trying to stabilize the market. Remember, there's been weak demand recently. Bloomberg pointed out last week's 20-year JGB auction saw the weakest demand in over a decade. Plus, there's been this painful global rout in bonds generally.
Okay, so Japan might issue fewer long bonds. But how does that spark a rally in U.S. Treasuries? That feels like a jump.
It does, but it's about capital flows. Michael Brown, a strategist quoted in the sources, put it nicely. He said, that potential lower issuance is giving treasuries a nice helping hand.
How so?
The thinking is, if there are fewer long-term GGBs for big global investors, pension funds, insurance companies to buy, some of that money might have to find a home elsewhere. And U.S. treasuries are a major alternative, so potentially more demand for treasury.
Right, driving prices up and yields down, I see.
And the numbers reflected that today. The 30-year U.S. Treasury yield fell as much as 9 basis points at one point, down to 4.95%. The 10-year yield dropped over 4 basis points to 4.47%.
And that puts the 30-year back below 5%, which it had crossed just last Friday.
Exactly. And that recent climb above 5% is key context. That move last week was largely chalked up to worries about U.S. government deficits, the fiscal picture here.
So you've got this push and pull, domestic deficit concerns pushing yields up, but then this external factor from Japan pulling them down today.
That seems to be the dynamic. And you had Benjamin Schroeder at ING quoted saying something like, today's rally might be brief because, quote, the fiscal trajectory still matters.
He's pointing to the bigger, longer-term issue, the Moody's downgrade, that recent House bill projected to increase the deficit. Those haven't gone away.
Correct. Some analysts are even making a distinction now. They're saying the recent yield rises were maybe more about this fiscal risk premium, whereas earlier rises might have been more about optimism over economic growth. It raises the question, is today just a blip reacting to Japan news, or is something fundamentally shifting?
And there's another Japan angle here that MarketWatch flagged, also connecting back to U.S. Treasuries. Japanese institutions are massive holders of U.S. debt, right?
Huge holders. And they're central to that whole yen-funded carry trade, borrowing cheap yen to invest in higher-yielding U.S. bonds.
And so what's the risk there?
The risk scenario is this. If JGB yields were to start rising significantly on their own, maybe because the Bank of Japan tapers more aggressively or inflation picks up there, it could make holding JGBs much more attractive for those Japanese institutions.
So they might sell their U.S. Treasuries to buy JGBs instead.
Precisely. It could trigger a big rebalancing, a substantial flow of capital out of U.S. assets and back into Japan. That's a potential vulnerability for the U.S. bond market that goes beyond just our own domestic fiscal issues.
Wow, okay. Global finance is complicated.
Tell me about it.
Let's pivot again. From government debt to what's often seen as the engine of future growth, or at least where a ton of money is flowing right now. Tech, specifically AI. The reports from Yahoo Finance and Bloomberg really hammer home NVIDIA's central role.
They really do. NVIDIA is basically described as the compute backbone for this incredible AI startup explosion we're seeing.
The numbers are pretty wild.
Yeah, PitchBook data cited in Yahoo Finance get this $306.5 billion invested globally in AI and machine learning startups just since the start of 2023.
$300 billion.
And $230 billion of that was in the U.S. alone. That accounted for almost half, 48% of all U.S. venture capital investment during that period.
Half of all VC into AI. That concentration is just... And it accelerated.
Yeah.
Q1 of this year, 2025, saw $66 billion invested in U.S. AML startups. That was over 70% of the value of all U.S. VC deals in the first quarter. It's completely dominating venture capital right now.
And NVIDIA stock reflects that, obviously, up, over 670% since ChatGPT launched?
Exactly. It reflects their foundational role. The big tech companies are pouring money into their chips. Bloomberg estimates Microsoft's dedicating something like 47% of its capital spending here, Meta around 25%.
So it's no surprise, then, that investors are laser-focused on NVIDIA's Q1 earnings report, which is due out Wednesday. Bloomberg mentioned investors sitting on something like $7 trillion in cash are watching this. Yeah, it's being seen as a crucial bellwether for the health of this whole AI demand story. NVIDIA's results aren't just about NVIDIA. They're kind of a proxy for the entire AI boom, driving so much market excitement.
But there's also a fair bit of caution swirling around NVIDIA right now, isn't there? MarketWatch noted the stock actually broke its winning streak last week, down about 3%. And Bloomberg mentioned it's trading, what, 14% off its January high?
That's right. So analysts are definitely watching closely, especially the guidance. Bank of America analysts, quoted by MarketWatch, warned the guidance could be, quote, messy.
Messy because of those U.S. restrictions on selling advanced chips to China, like the H20 chip ban.
That seems to be the main factor creating uncertainty. Those regulations are a headwind. The sources mention an expected charge potentially up to $5.5 billion in the April quarter, possibly linked to these restrictions.
Which brings us nicely to another tech angle in your sources. How are Chinese tech giants like Tencent and Baidu actually dealing with these chip curbs?
It's a key question. The CNBC report on this outlined a few strategies they're using to navigate the restrictions on getting those top-tier chips from NVIDIA or AMD.
Okay, what are they doing?
Well, Tencent, for instance, is apparently relying partly on a pretty strong stockpile of chips they managed to get before the rules really tightened.
Ah, building up inventory.
Seems like it. Plus, they're focusing heavily on software optimization, basically trying to squeeze more performance out of the chips they do have, even if they're not the absolute latest generation. And they're also exploring designing their own custom chips, homegrown solutions.
Makes sense. What about Baidu? Similar approach.
Pretty similar. Baidu is emphasizing what they call their full stack capability, controlling everything from the cloud infrastructure up to the AI models and apps. They argue this gives them more room to optimize software effectively. They also highlighted the progress being made by domestic Chinese semiconductor firms, suggesting they're becoming more viable alternatives to mitigate the U.S. limitations.
Interesting. And wasn't NVIDIA's CEO, Jensen Huang, quoted in that same CNBC piece with some pretty strong words about the U.S. curbs?
He was. He reportedly called the U.S. restrictions a failure, arguing they ultimately damage U.S. businesses more than they actually hinder China in the long run.
Wow. That really underscores the friction between geopolitics and the global tech industry.
Absolutely. It's a really difficult balancing act.
Now, staying within tech, but shifting focus slightly, security at tech conferences, CNBC had a piece on this. Seems like an unusual headline.
It is quite striking, but apparently major companies like Google and Microsoft are significantly boosting security at their big annual developer conferences, events like Google I/O and Microsoft Build.
Why? What's driving that?
It seems directly linked to employee protests, particularly around controversial government contracts. The sources specifically name Project Nimbus, that's the AI tech deal with the Israeli government, as a major flashpoint.
Yeah.
Yeah, there were reports of protesters interrupting keynotes at both Microsoft Build and Google I/O recently. People were removed, and some employees were reportedly fired over it.
So the companies are reacting with more security.
Exactly. Things like undercover guards, much stricter bag checks at entrances. Security experts quoted in the article say this isn't just about these specific events. They're seeing a general uptick in security needs for tech firms.
Why the general increase?
Several reasons mentioned. Tech companies doing more sensitive work with governments, rising political tensions globally, making them potential targets, and also, frankly, a desire to prevent these protest incidents from going viral online.
So managing optics as well.
Seems to be part of it.
Yeah.
And these increased security costs are actually starting to be noted by some S&P 500 companies in their reporting. It's another way these wider social and political currents are hitting corporate bottom lines.
Fascinating how it all connects. Okay, let's quickly cover a few other notable snapshots from the sources you provided. Chinese automakers seem to be having a rough time.
They do, according to CNBC. Shares of big names like BYD and Geely have been sliding. A big part of it seems to be fears of a worsening price war.
Triggered by BYD cutting prices pretty aggressively.
Exactly. They made deep cuts on popular models like the Seagull down 20% and parts of the Seal range down over 30%. That's sparking concerns about margins across the industry.
And there was something about regulatory scrutiny, too.
Yes, the Chinese Commerce Ministry apparently met with automakers about something called zero-mileage cars.
Zero-mileage cars, what are those?
Basically, cars that are registered as sold, maybe to boost sales figures, but then almost immediately resold as effectively new in the secondhand market. Regulators are looking into that practice, so price wars and regulatory eyes are weighing on the sector.
Got it. How about Meituan, the big Chinese delivery platform?
Also facing pressure, CNBC reported its shares hit an 8-month low. The main issue cited is intensifying competition in what they call instant retail, or rapid delivery of meals, groceries, everything.
So even though their revenue beat forecasts slightly?
Right. The competitive heat led analysts to cut price targets. The feeling is they might be spending heavily on subsidies to compete, hurting margins. though some analysts think that pressure might ease eventually.
Okay, but it wasn't all doom and gloom from China in the sources, was it? Bubble tea is apparently doing well?
Surprisingly well, yes. CNBC highlighted some sharp gains for Hong Kong-listed Chinese bubble tea stocks, companies like Mixu and Nayuki.
Huh. Why them?
They're being pointed to as a really strong consumer sector, even with the broader market weakness. Seems like the brands are just incredibly popular, and they have aggressive expansion plans, both in China and overseas. Mix's shares, for example, have apparently more than doubled since they listed back in March.
Wow, quite the contrast to the automakers. Okay, shifting way over to luxury goods now. The diamond sector is facing a, quote, perfect storm.
That's the term used in the Market Watch and CNBC reports, yeah. The natural diamond industry is getting squeezed from multiple directions.
Like what?
Well, first, U.S. tariffs. There's already a baseline 10% duty on polished diamonds, but there's worry it could increase depending on how those EU trade talks we mentioned earlier play out.
Okay, tariffs. What else?
Then there's just generally slowing demand for luxury goods globally. That's a headwind. But maybe the biggest challenge is the huge rise of lab-grown diamonds.
Right, the alternatives.
Exactly. They sell for way less, the sources mention an 80% discount compared to natural stones, and they're gaining serious traction. One study cited suggested over half of U.S. engagement rings sold last year used a lab-grown diamond.
Over half. That's a massive shift.
It really is. And the diamond supply chain is so complex and global, it makes the natural diamond industry particularly vulnerable to all these trade disruptions, too.
So how is the industry, like De Beers, responding?
De Beers, the big historical player, is making a clear pivot. They're reportedly focusing their marketing entirely on natural diamonds, now emphasizing the uniqueness, the emotional aspect, and they're apparently closing down Lightbox, which was their own lab-grown diamond brand.
Doubling down on natural, then. Interesting. What about oil prices? Where are they sitting?
Bloomberg reported prices are fairly steady, hovering around $65 a barrel. They seem caught between conflicting forces.
Like the trade talk uncertainty.
Yeah, that's playing a role. But traders are also looking ahead to the next OPEC Plus meeting.
Which got rescheduled to May 31st, right?
Correct. And the expectation, according to analysts cited by Bloomberg, is that the group will probably agree to another modest output increase. Maybe around 411,000 barrels per day seems likely.
So potentially more supply coming online.
Right. Oil prices have generally drifted lower this year due to trade worries and OPEC Plus gradually adding back supply. But $65 seems to be a bit of a floor for now while everyone waits for that meeting.
Okay, and one last quick economic note from the sources. Something about Japan losing its top spot globally.
Yeah, a little nugget from CNBC. After 34 years, Germany has apparently overtaken Japan as the world's largest creditor nation.
Really? How did that happen?
Well, Japan's net external assets actually hit a record high, but Germany's grew even faster. The numbers cited were $3.78 trillion for Germany versus $3.73 trillion for Japan. China's third at $3.3 trillion.
Why the shift?
Part of the reason suggested is Japan's own rising domestic interest rates. It's making Japanese assets more attractive to Japanese investors, so maybe slightly less incentive to park quite as much capital overseas compared to before.
Interesting dynamic. Okay, so pulling this all together from this pretty wide-ranging deep dive into your sources today, what are the big takeaways? What connects all these different threads?
I think a few key themes really stand out. First, you just can't escape the influence of trade policy and, broader geopolitics. It's not abstract. It's hitting market sentiment. It's driving real corporate decisions. Think Volvo, think the chip companies, and it's stressing specific industries like diamonds.
And it's pervasive.
Second, the global bond market is just incredibly complex right now. You've got this interplay between domestic worries like the U.S. deficit and these external actions like potential shifts in Japanese bond issuance that have immediate significant ripple effects. It's all interconnected. And finally, the tech landscape, especially around AI, it's this mix of just explosive investment and growth, but happening alongside really significant challenges, regulatory hurdles like the chip curbs, and even internal company dynamics like managing employee dissent and security concerns.
Yeah, it really drives home that you can't just look at one headline in isolation, can you? You have to connect the dots across policy, tech, global money flows to really get a sense of what's going on.
Absolutely. It's a truly tangled web right now.
Well, that was certainly a deep dive into the headlines from your sources today, so here's a thought to leave you with. Considering all these ripples from the tariff delays, the bond market shifts, the whole AI chip race, these specific industry challenges like diamonds or autos, how much of what we're seeing in the markets right now do you think is driven by sort of fundamental economic forces,
Mhm.
and how much is just navigating this really turbulent, unpredictable policy and tech landscape. What stands out most to you from this deep dive? Thanks again for providing the sources that made this discussion possible. We appreciate it, and we'll see you all tomorrow morning with new headlines from major financial magazines.